Hello guys, it's been a long time, but I thought I'd do a full portfolio update where I go through my £73,000 plus stocks and shares portfolio. A new milestone that has me very excited. This is made up of just 14 companies that are monopolies that have a particular competitive advantage in their field, with a focus on years of positive free cash flow that is expected to grow into the future. I'll cover the overall return of this portfolio in more recent times, then we'll go through each position, their weighting and overall return, and finally end on the stocks that I am actively buying now and what their returns might look like in the future. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. This is the overall portfolio. It's around £73,500. That 74k isn't actually real. It was about £500 sort of deficit essentially because I sold a position and it's not quite updated yet. And cost of active investment sits at about 62k and return on current investments is around £11,500. This is unrealised gains that I haven't sold out of yet. It's interesting because I have two separate sort of stocks and shares ISAs now. I have my Trading 212 account, which has around 60k in it, or 59k, and I have my interactive brokerage account, which I've been actively adding to considerably this year, which is now around £14,000, which is a lot higher than I first anticipated it to be. In terms of performance though, this portfolio was doing very well. It was outperforming considerably until the current year from January through to now. So we've seen an outperformance in SPY throughout this year period. Here we was doing very well, up about 13% against the market in February 2025. And since then, we've now pretty much closed that gap to almost exactly what SPY has returned, about 16% over the past year. This graph looks pretty damning on year-to-date basis. We've returned around 1% compared to SPY's return of 10%. But one of the things to consider when it comes to this is the change in GDP to the amount of dollars, the exchange rate, etc. Because the pound has massively increased in value year to date compared to the dollar, which decreases the value of all my dollar held stocks because they have to be converted back into pounds in stocks and shares ISAs. So that's up by about 8%. So more money I put into this account and into American stocks is getting a better exchange rate, but the money I already have in these stocks is, when converted back, going to get less in terms of overall pounds. So really it's the exchange and FX rate that's sort of affecting this portfolio. And when we compare this to Vanguard S&P 500 ETFs index that I would invest in here if I didn't invest in individual stocks, we're doing pretty well. We're matching them or beating them. So this is VUAG, which is an S&P 500 index that is on Trading 212 that I've considered in the past. And here it's up by about 0.3% for the year, and we're up by about 0.9%. So we haven't outperformed, but we haven't massively underperformed as this sort of graph sort of shows. So to kick it off then, this is my largest holding, and that is of course Amazon. This one's held in Trading 212. I've got 97 shares at an overall value of £16,500. It's over 20% of my overall portfolio and I have really high conviction in it. We're up by about £2,900 or around 22% or so. This one is getting negatively impacted by FX, down by about 6% or so. And our cost per share is $177 compared to our overall share price of $230. And it's recovered quite a bit from when we saw that sort of new reports and earnings reports that came out. Microsoft blew it out of the water with their growth rates in AI and cloud. And that sort of had a negative impact on the consistent but not really massively impressive growth rates of Amazon. And people were saying that Amazon are going to just get blown out of the water eventually by Microsoft at these growth rates. And I sort of see that at the current growth rates, but I don't think Microsoft can sustain them because they are shifting over a lot of their old clients to use their cloud service, like upselling, and that can't last forever. So in my mind, Amazon's doing fine. They've recently gone over to using sort of the same-day delivery option for fresh groceries. This is going to make them more competitive against Walmart and other ones like that. And more recently, that's had a good impact on the stock. It's up by about 3% when the market's been down or pretty much flat. So they're doing pretty well at the moment, and that's why they're my largest holding. The one that's doing excellent as well is Brookfield Corporation. This is my second largest holding and very close to Amazon in terms of its overall size. They're the only two that are this sort of heavy weighting at over 20% in the portfolio. I've got 323 shares at an overall value of £15,600. And we're up by about £2,700 or £2,800, around about 21 to 22%. FX impact is affecting this one very similar to it is with Amazon. And it's just been on a massive sort of ride, this one. In the past 3 months, up by about 9%. Past month, pretty much flat, about 3% up. So we're doing very well, and over the past year, it's up 45%. And I just love this stock in general. There's a lot of undervaluation with this business model. I don't think it's ever truly been appreciated by the market, so it's good to see it get a bit of recognition, as I think it should. Now we get to my international holdings, and these are my two biggest ones now after the likes of Brookfield Corporation and Amazon. Amazon and Brookfield take up about 45% to 40% now of the overall portfolio. And then these ones come directly after that, and they're considerably smaller in size. First, we have Vitec Software Group, which is a serial acquirer based in Sweden that does business in vertical software markets. And they essentially buy companies that are in vertical markets and then try to adapt them, change them, make them more efficient, use their cash flows to then go on and buy other businesses. And this business is very similar to Constellation Software and Topicus out of Canada. And they've done very well in the past, say, 5 years and lifetime, and they're having a harder go of it more recently. Mainly due to a few different things, like not really making acquisitions in the last quarter, comparing themselves to a very hard quarter year over year in 2024, where they blew it out of the water. So it's more a case of the share price is trying to catch back up with the high performance of the fundamentals. And more recently, this one is now about 7% of my overall portfolio, and I've been contributing it quite heavily because I'm seeing a lot of value here. We can see here on this graph here, I've got about 7.1%, around £5,200 in the position. And here on the graph, we see it down the bottom here, we're down by about 12% on the overall position. And I still think this is one that's going to do very well in the future. And I'm not particularly worried to be down on this position. Vitec has an excellent outperformance in most of its fundamentals. Year over year, they are growing very rapidly. This is their operating cash flow on just a normal graph year over year, and they've just done really well. They do some dilution, which is a concern. They don't have massive insider ownership like the next stock I'm going to talk about, but they are doing very well in their fundamentals and are very capital light in their business model. So that's very attractive for someone like me. I said that I was going to do this at the end, but I'll probably do it throughout. This is a stock that I'm actively buying into, and this is the sort of reason why. On a 5-year time horizon, with a 20% growth rate in annual operating cash flow, which they have evidenced and done in the past, which I think is perfectly possible for this business, with only a 2% dilution in shares because they've slowed this down considerably and still trying to allow for it, and with a price multiple that is, in my opinion, below fair. I think it could trade for 25. Bigger sort of markets than this have traded than higher this in the past, and this one over the past 5 years has averaged higher than 22. But if we allow for all of that, the fair value of this stock is around 800 Swedish krona, and it's trading for 379. So really, this one offers really good opportunities in the market, and I'm trying to snap up as much as I can. I'm kind of happy with 7%, but it could go higher if this price persists, and I don't see any other opportunities. Now, my fourth largest holding, something I've really tried to pad out in the most recent month or so, is Tasmea. And this one has just been on a massive roll in year to date, up 37%. It's done really well. The fundamentals are still undervalued if you ask me. And this is one I've really tried to build out in the portfolio. And I'm really happy to get it at the fourth largest holding. And I hope to take this one maybe past the likes of Vitec. It's just got an amazing business model and everything about it I really like. It's an engineering based company in Australia. They are also a serial acquirer, so they buy a lot of companies that are very linked to their business model, which is offering skill sets to maintain and build out critical software and sort of infrastructure for the likes of big companies in Australia. And they've done really well at this. They are expected to grow by about 15% organically over the next, say, 3 years. But they have grown their revenue by over 40% by also taking on a lot of acquisitions in that time. And they're planning to do more. And this is a business that is just growing on all cylinders. And they're getting massively rewarded in their fundamentals. Their share price right now looks very attractive, and this is because they are trading for a price to operating cash flow of around 15 times or so now, 14 to 15 times, and they're growing at well over 15% if we allow for acquisitions. So they don't really include their acquisitions in their guidance. And I think this one is just one that I've really tried to pad out with their insider ownership of 60%, recurring revenues of 95%. This one is just next to unlikely to be sued by anyone really, and it's just a market leader in their field in Australia. And I sold HIMS to buy into this company, and it's already up by a little bit. So right now I think we're up by about 8% on the overall position, and we've got around about £5,000 or £4,800 in the likes of Tasmea, and that's something that I hope to continue to increase if this share price stays as it is. And just to show you guys, a bit similar to Vitec, what we might be looking at in overall return. This one I use free cash flow. I've got a growth rate of about 17% because 15% organically and 2% for acquisitions they may make in the next 5 years, which I think is very conservative if you ask me. They could easily grow up to 20% potentially. And dilution of shares, they do dilute a little bit. I've allowed for 2%. This 22% is an error, essentially. It didn't happen in that same level of time. And price ratio is 22. And I've sort of done that because it's below the 5-year average and is still on the conservative side. Even then, we get a fair value of $7.85. And this is because I believe that right now, due to their most recent acquisition, they said that they could produce around 62 million in earnings. And that's quite interesting because that's not reflected in any guidance. So they've said they can produce 62 million after this most recent acquisition, and the market is yet to really price this in. And now we got a CAGR of about 24% year over year for the next 5 years potentially from this current share price, despite it being up 37% year to date. So that's why I'm snapping up this one as quickly as I can. Even on conservative DCF like this, they look very good at well over 24% in overall return. Now back over to Trading 212, we have my fifth largest holding, which is S&P Global. We have 11 shares at an overall value of £4,500. We're up by about 21% or around £800. And our share price is sitting at $426 compared to the current share price of $559. So we've done very well with this one. FX impact affected this one negatively about 7% or so. And it's still doing very well. Now, I love this overall business model of S&P Global. They evidenced this in their more recent earnings report, which they did very well in. So we've seen an uptick in the share price more recently, up by about 7% in the past month. And they're just doing very well and doing what S&P Global do well. They've got a next to monopoly in this industry along with Fitch and Moody's, and they're still growing the fastest out of the bunch. So I really like S&P Global's sort of overall business model, and its overall sort of weighting looks by around about 5 to 6% of this portfolio. Next, of course, we have ASML, which is my 6th largest holding. This one I have 8 shares of, an overall value of £4,300. We're up by about 23%, or around £800. And this one is still offering good value in my opinion, around $700 mark. I think it's done very well in terms of trying to recover from when I bought it right on this sort of low round here. Here. And I think that overall this stock is still signalling very good value because it's a monopoly in its industry. People sort of like to talk about Nvidia and Taiwan semi-manufacturing, but ASML give them all their machines. So there's no real way that I see a future for the likes of AI that ASML doesn't do well, because they have a scientific competitive advantage that is 10, 20 years in front of any possible competitors, not that we could even name them because they aren't known to us other than that China is trying to replicate what ASML are doing. So this Dutch semiconductor business is just amazing, and even though it's cyclical in nature because these machines cost hundreds of million to manufacture, build and ship, I think that ASML is still a very good play that I like to be exposed to. It's now about 5.9% of my overall portfolio, and it's one that I am quite happy to maintain. I'm not looking to necessarily add, even though it's undervalued. On to Fiserv. This one I'm down on. I've got about 40 shares, an overall value of £4,000. We're down by about £700, or around 15%. And this is one I maybe jumped into a bit quickly. I thought it was offering really good value at this sort of $160 mark here, and then it went lower, and that was mainly due to an earnings report where it didn't really sort of improve as well as I thought it was going to, and the sort of revenue growth slowed guidance-wise by about 2%, and it dropped by 18% on the day, which I thought was a massive overreaction. But the share price has sort of stabilised around this $136 mark, and if I'm honest, I still think Fiserv is offering really good value. I've built out my position now. It's around just over 5% of my overall position, and I'm not looking to add to it really, even though I think it's undervalued. I'm seeing more opportunities with the international markets. When I added to Fiserv, I wasn't really considering the likes of Tasmea and Vitec, and so really I'm not looking to add to Fiserv, but I still think that it's a very good point of sales business model that is the market leader in their industry, and they're the number 2 acquirer after JP Morgan as well, so they've got lots of business segments that are going to do very well for them, even though they've had a slight slowdown in Clover growth. So I'm still seeing good opportunities with Fiserv, and I'm still holding my position. Now we get on to Melli. I love this company. Around 2.2 shares, an overall value of £3,900. We're up by about £930, around 31%. Again, FX impact affected this one down by about 5% or so. And really, this one is just amazing. I think it still offers good value. Maybe not as good as when I was buying it down this dip here in December 2024. But it's not. I wouldn't look to time this one. Melli is an amazing business. I really do love it. They are growing very rapidly and on a massive scale. They are essentially the Amazon of Latin America, except that would be unfair to them. They've got an amazing fintech business that they built out completely themselves. I think they're managing the risk with that very well. They're growing over 70% in their overall fintech portfolio. Their ads business is growing very rapidly as well, and they're just sort of replicating Amazon's business model, except for cloud, really well. They started a new sort of almost Amazon Prime style sort of subscription model, and they also have started the likes of a TV sort of app that is very similar to Prime as well. So Melli is sort of copying Amazon, and I'm here for it, if I'm honest, because they've got the TAM and they've got the ability to replicate it, and they're just growing really fast. I mean, they're growing about 3 times as quickly as Amazon, and they are still quite a bit smaller, but I can see growing profitability with this business that Amazon never really had until cloud. So really, this one is actually doing very well. And so I actually like my allocation at just over 5%. I had this one almost as high as 10% previously and sold off a bit of it. And I'm sort of aware of the risks of this one, operating in Brazil and the likes of other countries that are a bit more, like Argentina, that are a bit more harder to predict. So I'm aware of that, and I've sort of allocated for that in terms of sizing of this overall position. Now we get on to Brookfield Asset Management, and I haven't owned this one very long. It's a subsidiary of Brookfield Corporation. It's a spin-off company essentially that they made for their alternative asset management business. They're a lot more of a simplistic business style to Brookfield Corporation, and they trade at a lot higher premium. Now, their business model may be more simplistic, but they're trading for quite a higher valuation now, if you ask me. I wouldn't be looking to add at this level. Whereas I would add to Brookfield Corporation. Brookfield Corporation trades at about 22 times sort of distributable earnings or price to free cash flow, essentially. And Brookfield Asset Management trades for around 35 to 40. So you can see here that already there is a premium that investors are willing to put to Brookfield Asset Management because they understand the business model a lot more. And I bought around this dip here, March 2025, when I thought it was offering really good value around this sort of share price of $43.67. And it's been up massively since then. Interestingly enough, Brookfield Corporation has outperformed it from its share price of $46 up to $65 now. So they're sort of mirroring each other, and I think from this point I would expect Brookfield Corporation to return better than Brookfield Asset Management. And if I was going to add to one, it would be Brookfield Corporation. The reason to hold on to Brookfield Asset Management now is effectively their dividend is quite high paying. I locked in a yield of about 3%. And also I think that investors are more willing to put a higher premium to Brookfield Asset Management because it's simplistic. How long that will go on for and how it will continue, I don't know. But with an allocation just over 4.5% or so, I'm happy to keep some in Brookfield Asset Management for now. But if we saw a big dip in Brookfield Corporation, I could see myself shifting Brookfield Asset Management, selling out of the position and going over to Brookfield Corporation. And that's still something I may consider doing, and I haven't pulled the trigger on it yet. But it's something to bear in mind because I think Brookfield Asset Management is still not offering as much value as Brookfield Corporation at the moment. And here we have Visa, which was a very big weighting in my portfolio, around 9% or so, and I've continued to trim this one down. It's now about 4.5% of the overall portfolio, I think, something like that. I have 11 shares, an overall value of £2,700. We're up by about £498, up by about 21%. And this one is again being affected negatively by FX impact, but I have sold out of it recently because I'm seeing like better opportunities elsewhere, and from this point, trading at this valuation, I don't see Visa making market-beating returns. The reason to hold on to it though is because if the market tanks, I believe Visa will hold its value really well. It always does. It does well during downturns, and I could see Visa doing very well from here. It's sort of where I'm keeping my money at the moment until I see a good opportunity. I thought I saw that in Fiserv. That didn't really pan out. I'm glad I held on to more Visa and didn't sell out this position entirely. I've trimmed it a bit to add to Tasmea more recently. And I think this one is one I'm going to hold on to until I see a really good opportunity and maybe sell out of the position. We have Fast Accounting, which is one of my Japanese held companies. I have about 3.5% position in this one, and we're pretty much flat on our position or current share price. And over the past year, shares of Fast Accounting have done very well. They're up 56% in the past year. However, year to date, they're pretty much down by about 8%. And there's not really a reason for this other than Japanese stocks are still continuing to do really well in terms of fundamentals. They're growing their free cash flow and operating cash flow really well. But they're receiving less of a multiple expansion than businesses, say, in America. So what I'm seeing is Japanese markets are looking really good in fundamentals. They're given really good growth rates, and yet the market is pricing them down. They have grown their revenue up to 1.7 billion yen in the past 4 years. This is around about 4 or 5% times in 4 years. Their cash from operations has gone from negative to positive, now having about 530 million in positive cash from operations. And they've grown it by over double year over year. So really, I'm seeing good value and opportunities with fast accounting. This business could return up to 30% or similar to Vitec in the coming sort of years. And I still see fair value for it. The only reason I've got smaller allocation, around 3.5%, is because I'm concerned about the moat. Fast accounting make their money through offering accounting services that are powered by AI to smaller businesses in Japan, and they have the number one market sort of share in this industry. They have a quite dominant market position. They're not going anywhere, but it's interesting to see how they would grow, because they talk about going into international markets, and this is somewhere where I could see them maybe underperforming potentially, so we'll have to wait and see on that one. Back over to Trading 212 for the last time. My smallest position in my Trading 212 account and second to smallest holding is Texas Roadhouse. This is one I've held for quite a while now. 18 shares, an overall value of £2,298, around £600 in the green and 36% up. FX impact is affecting this one again, similarly to the others. And our share price at the moment is sitting at a cost per share of $118, and it's up to $173 at the moment. They had a more negative earnings report quite recently, and this is something that I'm bearing in mind for the future. They're down by about 6% in the month. And I don't know if this one is really holding its value very well. I think it's really pricey for how quickly it's growing. It's growing by around about 12 to 10% now, which is not as fast as when I bought it back here. It was growing by around about 17 to 18%. And in the space of a year, their growth rates have massively deaccelerated. So it's one I'm keeping my eye on, but I haven't made any decisions with regards to this one yet. I couldn't forget, of course, United Health Group, which is a small percentage of this portfolio. I think it's about 3% now or something like that. United Health Group has 10 shares, an overall value of £2,200. We're down by about £580 this position, which was considerably less than what we were down like 2 days ago. And this is because of the Buffett effect. So I made a video on it, but essentially Mr. Warren Buffett bought into this one. It's now seen a massive uptick in share price from the lows of $240 all the way up to $310. And the reason we're sort of seeing this is because maybe it's a bit of a vote of confidence in United Health Group. To me, there still isn't a fundamental improvement in the overall business of United Health Group. In my mind, United Health Group was a very good position and value play, but going forward, I want to see the management team continue to execute well on very conservative guidance. They gave guidance that was well below what they were expecting because of Medicare expenses and mispricing a lot of insurance-based sort of plans. So hopefully they can sort that out going forward. They're talking a lot, and hopefully the antitrust investigations can get dealt with without massive settlements. If they don't have massive settlements, United Health Group is still looking very attractive right now. And really, this is still a small position, but it's one that I'm maintaining. I'm not looking to add to until I see very good fundamental improvement maybe, but I could also equally look to sell out of this position if I'm honest, because this is again similar to Hims and Hers Health, an industry that I'm not too sure I want to be investing in, and not too something I think I have a handle on, with the likes of FDA regulations, insurance plans and stuff like that not being my main focus as an investor. Then we have my smallest position, which is Hennge KK, or 4475. This is a cybersecurity based company that is based in Japan again, and they are an incredible business that year to date have done very well, up 46%. We're up by about 7% on our overall position, or 6%, something like that. They're very volatile, down today by 6% on no real news. They're very similar to Hims in terms of volatility, but they continue to go up, they continue to do well. That's because the fundamentals are still very good. This one trades at a higher multiple than fast accounting, But I think their moat is more established. They're number one in the cybersecurity sector. I think over 50% of all of the sort of businesses that are in the sort of Japanese markets use Hennge KK. So really, they have a massive, overwhelming advantage in their field, and they're really doing well at upselling Hennge One, which is their main business model, to the likes of these businesses. And if we just look at the financials on these businesses, we see why I'm owning these over maybe businesses in the UK that aren't growing as quickly and stuff like that. When I look at businesses like this that are just doing amazingly well in terms of growth rates, since 2018 they have grown from 2.8 billion in revenue to 8.4. That's really consistent recurring revenue as well. This is not just take rates that are going to go away. Cash from operations have grown at a steady rate since around 2021. They have used that to sort of feed back into capex and stuff like that, where they're doing build outs. But since 2021, they've I think about 4 times it in about 4 years. So they're doubling almost every year, which is just amazing. And this is a business that has an amazing insider ownership of around about 44%, whilst Fast Accounting has around 50%. And the likes of Tasmea has 60%. So when I look at these businesses, this business, for example, has 44% insider ownership, massively aligning the shareholders with the management team. Just the same as Tasmea, just the same as Fast Accounting. This is not like businesses I am seeing in the US, where there's quite a lot of shareholder dilution because they're not really shareholders themselves as the management team. They own shares, they just don't own a lot of them. So I like seeing this, and I like sort of dipping into this to see how this performs going forward for the next 5 years. So maybe this is a bit of an experiment. It's only about 2.5% of my overall portfolio, but I hope this one will do well, just like Fast Accounting will. But we'll have to see how the Japanese stocks and the Australian stocks perform. But I'm really liking my international stocks at the moment. As I showed with the other ones and the Vitec position, they offer really good value at the moment, and I'm not seeing that value anywhere else in other markets. But thanks for watching, guys. I do appreciate it, and I'll catch you in the next one.